Hello, everyone, and welcome back to Dividend Compounders with Cheese. Today, we are taking a look at Norfolk Southern Corporation, ticker symbol NSC. In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or disgusting dividend stock. A call out that I wanted to make is that NSC is near its 52-week low right now. NSC is a company where some of my college peers went off to work for after graduation, so it's always been on my radar. And back when I pursued my MBA, I learned about the different modes of transportation for America's supply chain. And surprisingly, we move most of our goods through truckers. However, the second most are the railroads. And the reason why a railroad company might be a good investment is their economic moat surrounding their infrastructure and America's dependence on them for moving oversized raw materials that trucks can't. With that said, this is NSC's railroad network. They are responsible for moving a ton of materials and goods across the eastern portion of the United States. This is their territory. Whereas when you think of Union Pacific, the other very popular railroad stock, they're responsible for the western side of the US. And if you're wondering why there's a divide, well, the railroads are a toll booth type of industry with high barriers to entry. So this YouTube channel is focused on dividend compounders. So let's see if NSC is up to our standards. So in 2013, they paid $2.04 per share. And year over year, it looks like they consistently grew their dividend, and now they pay $4.96 per share. So let's take a zoom back right here and take a look at their dividend profile. Their payout ratio is very healthy, 59%. The dividend yield is 2.74%. It's not the highest, but it's certainly not the lowest. And let's go ahead and look at the historic PE ratio and the stock price. So back in 2010, it looks like it was trading at about $39 per share with PE ratio of 11. Fast forward to today, the PE ratio is sitting at 17.7 and the share price is $196 per share. The next metric we are going to be looking at is the shares outstanding to see if they're diluting the shareholders or buying back shares. So it looks like in the past 10 years, they have been buying back shares dramatically, aggressively, and this is a good thing to see. And now let's go ahead and look at their most recent Q3 earnings report. So they beat their estimated revenue by posting $2.97 billion in revenue, but slightly missed their earnings per share estimate. So the analysts expected them to do $2.74 per share, and they posted $2.65 instead. Also, they had to pay $163 million for the Ohio incident when their train was derailed. However, I liked their CEO's response to the accident, and hopefully it's not just lip service. He said, a crisis is an opportunity to really kind of like test your leadership and your resolve. It's also an opportunity to accelerate change. So after that Ohio debacle, it looks like NSC took some learning lessons and they are going to implement new changes and Kaizen to make it safer for everyone. Next, let's take a deeper look at the technical indicators. It does look like NSC was oversold in the month of September when it reached an RSI of 24. However, there does seem to be a line of support every single time that the stock price touches the lower Bollinger Band. However, with that said, it does look like NSC is rebounding because the RSI is now currently at 53, which is a healthy number. All right, friends. And finally, we are going to be doing some valuation models to determine the intrinsic value for NSC, and then to compare that number with what Wall Street analysts think the price target should be. The first one is going to be the multiples valuation. Essentially, we are taking similar companies in the same industry as Norfolk Southern, deriving a median PE ratio of 23.19, which gives us a multiples valuation price of $211.56 per share. Moving right along. The next one is going to be the discounted cash flow analysis model. Essentially, we are going to reach an intrinsic value for NSC based on its free cash flow growth year over year. So it does look like the average growth rate is sitting at 8.62%. It's healthy. It's not double digits, but it's good. However, I am going to play it safe and conservative and divide that by 2 and plug in 4.5% instead as their free cash flow growth rate, and plug in that 4.5% with some balance balance sheet numbers, we reach a price of $153.83 per share. Moving right along, the next one is going to be the dividend discount model valuation. We are going to reach an intrinsic value based on its dividend payout and its average growth rate. So it does look like year over year, the growth rate is sitting at 12.19%. This is a dividend compounding stock. This is what we love to see. However, I am going to be safe and be conservative and divide that by 2. So I'm going to plug in 6.5% into the formula, which gives us an intrinsic value for NSC, $383.40. My goodness gracious. And mind you, I did not use that 12% average growth rate, which is what the data and finances actually say. Instead, I went with 6.5%. So moving right along, the last one, I call this the bear valuation case. We are going to find an intrinsic value based on its growth rate projection and the current AAA corporate bonds yield rate, $138.79. This never lets me down and giving me the most bearish numbers. And now the conclusion. After we calculated all those valuation models, what is the intrinsic value for NSC? Drumroll please. $221.89. Let's see how far off we were from Wall Street analysts. The Wall Street analysts predict $237.15, which is a 20% upside from its current trading price of $196. The low price target is $170. The high is $275. So compared to Wall Street, it does look like we are a little more conservative, and that's because I literally divided each growth rate by 2. So based on these numbers, let's figure out if this is going to be a delicious dividend determination or if it's going to be disgusting. So at its current trading price of $194 plus or minus $1 or 2, with a 10% margin of safety baked in, your acceptable buy price would be $199.70. And right now, it does look like at that trading price, it is undervalued. However, if you do want to be conservative and bake in, I don't know, 15%, and your buying price would be $188.61. With a 20% margin of safety, you are looking to jump in when it's $177.51 per share. So what am I personally going to do? I think every single time that it reaches $190 or below that, I will probably dollar cost average or watch to see if it trades sideways. And remember, don't just think of this as buying a stock and hoping that it goes up. My mentality is the belief that I am buying into a company, a business with real operations, with a real service or product. And I'm becoming a part owner of it because I truly believe that it's better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. So at the end of the day, I do think NSC is a delicious dividend determination. It has a huge economic moat. It has competitive advantages. It is undervalued and its dividend growth rate is double digits. However, before you end up liking the stock, please do your own due diligence and research to figure out if you like NSC. And with that said, this has been Dividend Compounders with Cheese signing out. Stay safe, and I will talk to you next time.